Long-term investing and strategic asset allocation. I think this conference is very timely. We are 12 months into the recovery, and I was talking to Mark Wills from Goldman Sachs last week, and he was prepared to call the GFC over, and I think that's pretty well right. I'd say we are starting to get enough confidence to say that the worst is behind us. That doesn't mean that the future is certain. Talk a little bit about certainty and uncertainty. We have Cooper Review coming up. We have Henry Review not yet tabled. There is great uncertainty about what is in those documents. And so there is some trepidation about the future. But right here and now, it is back to business as usual. We remember that we've got our day job. We are getting on with the process of investing, the process of deploying capital on behalf of our members. And given that, I think it is a good time to gain perspective, to have a look at the lessons from the past and start thinking about the future. Now, what I'd like you to get out of today is a little bit more understanding about the worth of strategic asset allocation. Maybe challenge your ideas about where it sits in the investment program, and discuss some of the lessons in relation to strategic asset allocation that came out of the GFC. The last thing I'd like you to leave you with is a sense of comfort that, by and large, the structures that you have put in place to deploy capital are appropriate. You know, the rules have not changed, and in regard to long-term investment, there is no need to throw the baby out with the bathwater. Now, some of you might be thinking that strategic asset allocation is a quantitative technique, and the one thing that the GFC proved is that quant doesn't work. You know, the correlations and the assumptions we made about correlations were simply worthless. Okay? The second thing you might be thinking is long-term. You know, in the long term, the only thing that is certain is death and taxes. So why are we worrying about long-term investing when we have to get through the next quarter, the next year, the next 3 years? And finally, I'm from Russell, so you may be fearing that this may end up as a product flog, and I assure you it won't. As we go through the presentation, I'd like you to think about what are your objectives. Not there yet. You know, what are your real objectives? Not just the stated objectives, not the thing that goes out in publications, not the thing that asks for reviews, but what are your real objectives investing, and what are the time frames that those objectives are going to be achieved after? I'd like you to think about, you know, whether or not the strategies that you have in place are appropriate given that objective set. And the last thing I want you to think about is whether or not the governance structures support those strategies, whether or not at times of crisis when your beliefs are really being challenged, the governance structures around your investment program support the achievement of those long-term objectives. What's the session about? Role of SAA in decision-making frameworks, nature of long-term returns, SAA issues. We'll talk a little bit about home bias. We'll talk about problems in implementation. We'll talk about problems incorporating alpha in strategic asset allocation. Finally, we'll talk about SAA and the GFC. What I'm not going to be talking about is quant modelling. Okay? So if you've come for, you know, the latest in volatility, jump diffusion, stochastic modelling, you're going to be disappointed. It's not going to be a defence or condemnation of optimisation. Neither is it going to be Russell's capital market forecasts at this point in time. The last thing it's not going to be is a particular recommendation on any strategic asset allocation profile portfolio. Bill Moiskin, my first boss at Russell, at Mercer, 15 years ago. Gee, that's a long time. Used to say that any good presentation needed to have either a globe or a pyramid. I haven't got a globe in this one, so I had to go with a pyramid. Talking about this a little bit. Strategic asset allocation is a component of an investment program. It is not an entire investment program. By strategic allocation, I'm going to define that as capturing your beliefs about the future behaviour of investment sectors in a set of metrics and then using quantitative tools to generate a portfolio that has the highest probability of achieving your objectives given the metrics, given those assumptions. Okay? So it is long-term, it's quantitative-based, and what it is capturing your beliefs about the behaviour of markets in a set of numbers. Now, how you get from that belief set to the final portfolio is there's enormous ways to do that, and certainly there has been a lot of criticism of optimisation techniques, and we now, I think, Russell, I think every other consultant out there would rather be robust and roughly correct than absolutely mathematically pure, only be blown out of water when the stability of those assumptions is called into question. But strategic asset allocation is part of the picture. We've talked a lot recently about dynamic asset allocation, and at the top of the pyramid is active management. So SAA is part of a structure, part of a program. How much emphasis you put in SAA compared to dynamic, compared to active, has a lot to do with your time frame, and it has a lot to do with your beliefs around market efficiency. The longer your time frame, if you were investing for 20 years or 40 years, the more crucial a good SAA is to that investment program. If you're investing for 5 o'clock this afternoon, or next month, or next quarter, or even to the end of the next year, then SAA is virtually immaterial. Okay? And what you're looking at is active management. Okay? You're looking at what is going to, given where markets are now, given valuations, given my outlook for GDP and exchange rates and all these other factors, okay, what is where should I allocate my capital on that time frame? So the longer your time frame, the more important strategic asset allocation. The shorter your time frame, the more important active management. Market efficiency and DAA is a fairly hot topic. And I think Sean Hennigan had some comments recently about consultants piling into the DAA market. And a couple of people have commented that Sean used to be a consultant, and so if he can do DAA now, why couldn't he do it then? But anyway, so market efficiency. I think if you believe, if you inherently believe in strong form market efficiency, then SAA is going to capture the behaviour of markets. You've got strong conviction in that, and SAA is going to be the foundation and the principal component of your investment program. However, if you believe that from time to time, due to irrational fears, animal spirits, fear and greed, that you have points in time where markets are being driven, in fact exist in a state of disequilibria, then dynamic asset allocation is going to shift you away from strategic asset allocation during those points. And I think most of the consultants, certainly Russell, certainly what I've read about the program implemented by MLC, have adopted a do-no-harm approach to dynamic asset allocation. So certainly this idea that the prime purpose of DAA is protect capital when the apparent risk within an asset class is becoming extreme, or the disequilibria in that asset class is so apparent, absolutely so apparent, that it's a dereliction of fiduciary duty not to react to that circumstance. And I think that's how it's appropriate. I think having a default to do nothing is the appropriate approach for a DAA program. Active management looks at, okay, well, markets aren't that efficient. And there's a hell of a lot of information that needs to be incorporated in a price of a share. And if you have a wide dispersion of views, then mispricing opportunities are going to arise. And in that environment, there's going to be a return to skill. So it is worthwhile paying a fee to skilled managers to extract an alpha from the market. So anyway, that's my view of where SAA sits in the investment program. I think it's absolutely crucial, but it's not the end of the story. So long-term investing. I was having a think, the Academy Awards, Avatar, and you know, James Cameron didn't get Best Picture, and you know, his ex-wife got it, and all these other things. But the concept that we might go and mine on another planet, and I know Sam is in the audience up the front here, and if someone came up to Sam and said, Sam, I want you to give me $1 billion. We're going to go to another planet and we're going to mine raritanium, and 20 years from now we're going to come back and we're going to make a mozza. And Sam says, well, that seems like a good idea. There's a couple of counting issues around that, but, you know, let's see a proposal. And then 5 years later comes back and says, Sam, well, we've run into a problem. That planet that we thought was uninhabited actually has 10-foot-tall blue people, and they're very upset, and as a consequence, you know, we need some security up there, so give me another $1 billion, we need to raise an army. Long-term is very, very hard. You know, long-term is extremely hard. I often think that if appropriate risk measures, risk structures existed, Columbus would never have discovered America. You know, it just wouldn't have happened. A couple of quotes out there. The future is a foreign country and we don't know it, from David Loyal. Jim Franks, a very long-serving consultant at Russell. Anybody who thinks they can predict the world 20 years from now is operating with a substantial level of humour. I think that's about right. So to try and think about long-term investing, let's just have a look at what's happened in the last 20 years, and I'm sure there's been plenty of discussion of this over the last couple of days. 1989, the Berlin Wall came down. The Soviet Union commenced its breakup. Fukuyama wrote The End of History. If anybody hasn't read The End of History, the gist of it is that the Western democratic capitalist model was clearly superior. Everybody would realise it's clearly superior. They would move to that model. We are now effectively at the end of conflict. 1989 was horrendously optimistic. I don't know if anybody remembers how, you know, good it felt. We'd come through the Cold War. Reagan had effectively won that. We were no longer worried about nuclear annihilation, and the future was a bright and shining path. Since 1989, we've had Rwanda, Yugoslavia, Desert Storm 1, 9/11, Desert Storm 2, Afghanistan. History wasn't quite over, and perhaps the world is not as certain and as optimistic a place as it was back in 1989. Since 1990, in the last 20 years, 31 new sovereign states have been created, most of them former USSR states. The opening ceremony, the parade of athletes at the Olympic Games, it takes forever. In 1990, GDP rankings, looking at economics, USA 1, USSR, doesn't exist anymore, 2, Japan 3, Federal Republic of Germany 4, France 5, Australia 12. Move forward 20 years, the EU by currency is now the largest economy, didn't exist. Okay. USA is number 2. This surprised me. On a PPP basis, Japan is still number 3. China 4, UK 5. Australia, despite digging very large quantities of things out of the earth and selling it to China, has actually slipped to 16. Medicine, the Human Genome Project started in 1990. In 1990, there were two things that were certain. You'd never cure cancer or the common cold. Well, guess what? You go 20 years forward, you have a vaccine for both. We started cloning, Dolly, and stem cell research. The CAT scan was introduced 20 years ago and revolutionised medicine. Technology, email. Who hates email? Okay, didn't exist. Well, it did exist, but it didn't exist in a commercially viable form. Spam, internet, Facebook, YouTube, Twitter. We were listening to our music on vinyl. We played cassettes on our Walkman. We watched TV. We recorded things on VHS. You know, the technology has just transformed the way we live. Investing, CIS in 1993, put some structure, effectively created the industry, and here we all are. If we were consulting to a fund in 1993, we'd have a discussion about should you invest in the BT retirement fund or should you invest in the AMP Growth Fund? Which balance fund should you return in? Conversations in 1993 with Oliver Rahn were very interesting. I think he failed to see the value of consulting and consulting research. We've stumbled from one disaster to the other. LTCM, Enron, Madoff, Lehman. The list is endless. So what are we going to see in the next 20 years? I'm not even going to have a crack at geopolitics. Goldman Sachs tell me that 20 years from now, the largest country in the world will be China, EU will be second, USA 3, India and Brazil. Don't know where Australia sits in that list. I think it's down somewhere in the mid-20s. World Health tells you that the life expectancy will be 85, life expectancy at birth 85, an investment challenge around superannuation. But the scientists tell me they're very close to cracking the genome for ageing. So there could be a massive expansion in age expectancy. So you're talking about 100, 140. New cures, but re-emergence of old diseases. We terrified ourselves last year with swine flu, but more people died of typhoid and cholera. Old diseases are becoming more resistant to cures and will pose a bigger threat. Technology, 3D TV exists now. Space tourism exists now. Thought-directed control, putting electrodes on your head and controlling your computer or your TV. It exists now. I was reading in a scientific magazine, beam me up, Scotty, Star Trek, the idea that you disassemble somebody at point A and reassemble them at point B. Well, they're doing that in the laboratory now. It's only molecules. Climate change, I think, is a major theme of this particular conference. It will be warmer. We will have higher sea levels. There will be changes in rainfall patterns. And if you believe a recent study out of Germany, there will be conflict as a result of climate change. So in that environment, over that 20-year period, what happened to market returns? Well, funnily enough, Australian shares managed, despite the last 10 years, double-digit returns. We tend to forget how good the 90s were. And certainly Tony Day at the Future Fund, great believer in mean reversion. One of the things that he argues was you could almost predict that the 2000s were going to be terrible just because the 90s were so good. One of my colleagues in London tells me the terrible things about the 90s is that we learnt nothing, that we didn't go through enough pain to take any lessons from them. Australian bonds, 8.9%, cash, international shares hedged, 6.3%. Forward yield premium is a wonderful thing. International bonds and property securities. The returns over that 20-year periods haven't been too bad. The next chart, just take a little bit of time to explain. The data here is from the Dimson-Staunton-Marsh Millennium database. It's looking at the last 100 years. And what you've got there in terms of the blue boxes is the 20-year performance of a typical 70-30 balance fund. The red boxes represent inflation over a corresponding period. The average return of the 70-30 fund over the entire period, 9%, inflation's none, 4.3%. And you can see there that the value of strategic asset allocation is, by and large, that strategy has worked. That strategy has been successful in delivering performance to investors above the rate of inflation. You can see there it got really close. For the 20 years to 1980, it got really close there. We had OPEC jacking up the price of inflation. Real returns over most of the 70s were negative, and it was very difficult to generate. But markets did recover. And over that 20-year period, you did end up. Now, given that most of our members are actually investing from start to end over a period of 40 years and not 20, it gives you some comfort that a strategic asset allocation approach to an investment structure is appropriate for those long-term members, provided that they stay in the strategy for the entire period. The line at the end there from that last box just shows the rolling 20-year data in a little bit more granular fashion. And you can see there that over the last 10 years, that 20-year return has eroded quite significantly. But it's still around the 9% level. As I mentioned previously, SAA is about incorporating your beliefs as to the behaviour of asset classes in a set of metrics, in a set of numbers, and modelling them. Typically, when we look at equity markets, that belief will distill itself into a view about forward interest rates and an estimate of an appropriate equity risk premium. And you might come at a lot of different ways. You can look at the economic growth. There are a number of ways you can take to come up with assumptions about forward equity market returns. In the large, they are top-down. So you're making a top-down estimation of what equity markets will provide. But if you look at the Australian, and this is true of many markets, not just the Australian, but if you look at Australian, you get to nearly 50% of the market with BHP and 4 banks. So what you are experiencing is not an exposure to the economic growth of Australia. Let's face it, BHP is probably more exposed to China than it is to Australia. You're actually exposed to the ability of the management of a handful of companies to efficiently manage the capital that's been allocated to them. So home equity bias is a problem. Now, there are many reasons why you might have a home bias. From a liability framework, most of your liabilities are effectively going to be linked to the performance of the domestic market. In the case of Australian shares and access to franking credits, there are after-tax reasons why you might have a home bias. But by and large, if you look at the fact that most people have a bigger allocation to BHP than they do to the entire emerging market, the emerging markets, then it is difficult to perhaps justify the level of home bias that we do. Certainly not so much in Australia, but in other regimes where the tax implications are not as significant, you sort of wonder. The tyranny of pie charts. Comment up there, there's no guarantee that the characteristics of the investable opportunity set is consistent with the assumptions incorporated in modelling. We do an SAA study. You know, we throw all our numbers into a number cruncher, we turn the handle, and we come out with a strategy that has the highest probability of achieving our objectives. And we create a pie chart. And, you know, you might work with a consultant to do that, you might work in-house, but eventually it's going to come from a strategist to a CIO to a board. And all of a sudden, you have an asset allocation here, and there is a pressure to move from your existing policy portfolio to the target. But the thing to remember is that the estimates, you know, there are certain assumptions around some of those asset classes, and particularly some of the illiquid and alternative asset classes that may not be investable. David Neal at the IMCA conference was very open in talking about the pressure to get invested and the problem that the opportunity, the investable opportunity set, was not always there. I thought it was a very good presentation. Why is this important? So you've got a governance structure that's saying, are you invested, are you invested, are you invested, and you're going back, not yet, not yet, not yet. So there's pressure there. From a governance perspective, there's pressure there. In 2003, we're sitting there somewhat in shock. The tech bubble has unravelled. We're looking for an alternative to public equities, somewhere to generate returns that doesn't leave us vulnerable to that public equity market volatility. David Swenson published the Yale model, tremendous success, bought the book, you've read it. You understand that an alternative to a typical SAA is a model which has A lot of investments with equity-like returns, but because you have a longer time frame, you're able to extract a liquidity premium from the market. And one of those asset classes is private equity. So in 2003, you look at that 16% there. This is the IRR on private equity in the US, in US dollars, as an asset class as a whole. So it's going from the venture capital stuff through to the buyout, mezzanine, the whole gamut. The data is provided by Venture Economics. So you're sitting there in 2003 and you're looking at the returns, the IRRs that have been provided by private equity, and you think, well, looks attractive. Absolutely looks attractive. So you make an allocation to private equity, okay? And you start a program. You've understand a lot about the asset class, you know about J-curves, you know issues preserving equity between members, but you start a program in order to fill that wedge of the pie chart. The only trouble is a lot of other people have made exactly the same decision, and between 2003 and the end of 2006, $3 trillion goes into alternative investments, principally private equity and hedge funds. As a consequence of that, the fundamental characteristic of the asset class changes. The type of investment that gets funded changes. The quality of the asset, and managers, rather than looking to find the best opportunities to deploy capital, are suddenly under pressure to find any opportunity to deploy capital. And I'm sure we saw newspaper reports of companies in the US that were being advertised for relisting before the takeover had actually been complete. So it was still on the market. The plan was for private equity to take it out, restructure it, inevitably re-gear it, put it back on the market. They were advertising the relisting while it was still listed. So things change, and particularly as an industry, things change when fashion and investment fashion plays a part. Temptation of alpha. Little example here. If you have a typical 60-40 fund, how do you go and find some more return? It's very easy to make assumptions about alpha and incorporate that in your plan in order to achieve target rates of return. And making an assumption of 1% 1% alpha is very similar to moving your 60-40 fund up into an 80-20 fund. I make the comment that alpha is hard. I'll just make the comment that that markets, true alpha, true return to skill, is a zero-sum game. And we can all make an assumption about our ability to go out and find and select skillful managers, but 50% of us globally are going to wrong. I don't know, maybe Australia and Australian investors are inherently more sophisticated and inherently better at manager selection than the global norm. We've all seen studies of the experience of US mutual funds, where the experience of the average investor is very, very significantly worse than the experience of the average fund. Okay? That being said, 1% is difficult, and incorporating alpha in strategic asset allocation is very, very problematic. And if you're doing an SAA study, whether or not you incorporate alpha at all, I think has to be questioned. Governance structure. GFC created stresses on decision models. That's kind of obvious. One of the things happening in the GFC was a lot of people really, really questioned your investment belief. I think the worst example of that in Sydney was the Anglican Archdiocese, who had a leverage growth strategy going into the GFC. Now, if you have a 50-year time frame, an ability to wear a hell of a lot of risk, and a pain threshold enormously high, a leverage growth strategy is entirely appropriate. However, the Anglican Diocese did not have quite the pain threshold necessary for the strategy, and they unwound it. And unfortunately, they unwound it between November and March. at precisely the wrong time. I actually wonder what those numbers would be had they persevered and actually captured most of the bounce back. So one of the issues there is, are you actually, have you implemented a strategy consistent with your pain threshold? And if the answer to that is yes, does the governance structure actually support that decision? Does the governance structure, do the board and the people that you report to prepared to put up with the pain and the very, very significant pain that can be incurred in a crisis? Most superannuation funds ask themselves those questions and do have the structures to support the decision. But one of the things that we did beat ourselves up a lot on was rebalancing. Very famous quote for those military historians from Napoleon: never reinforce a losing position. And rebalancing felt a lot like reinforcing a losing position. On the 12th of September, when Hank Paulson got up, had his orange juice, cup of coffee, and decided that he'd allow Lehman Brothers to go bankrupt, the world kind of fell apart. A lot of people thought in that kind of crisis that rebalancing should be suspended. What the next couple of charts show is the result of that kind of decision. What I've got here is rebalancing ceasing here in October. So Lehman's have gone broke. The world is going to hell in a handbasket. We're probably being asked to cough up millions if Rob Zink was talking about $1 billion. I never heard anyone signing an FX margin call for $1 billion, but again, coming back to poor old Sean Hannigan, who I'm picking on, I think he signed a cheque for $800 million. It must be tough. This is the reference chart. This is for those people who believe in rebalancing, didn't stop. Okay, so from the crisis through to present day, started with 100, ended up here with, I think, 88.5. The second line here is, okay, Lehman goes broke, world is in crisis, stop rebalancing, okay, and then recommence 1 month after markets hit their bottom. This is the crystal ball. This is the people who, in April 2009, have the foresight to say, the GFC is over, markets are going to recover, therefore we'll recommence rebalancing. It adds about 1%. Perfect foresight added 1% to a disciplined rebalancing strategy. I think this is probably a more typical example where you're talking about commencing rebalancing in June 2009. There's enough recovery in the market that there's a little bit of comfort around the recovery of markets. Compared to the disciplined rebalancing strategy, you've actually destroyed 25 basis points. Okay? So even if your governance structure is so good that you can stop rebalancing and then recommence 3 months after markets have hit their bottom, and by the way, in June, I don't know anyone was calling the crisis over, you actually destroyed value. And the green line here is recommencing rebalancing 6 months after the market's to the bottom, where, in fact, you've destroyed 58 basis points. One of the things you might actually note around that is that, in absolute terms, the decision to continue rebalancing or not rebalancing didn't make that much of a difference. I do make the comment that if we all look at the Chant West League tables, 100 basis points, even 58 basis points, does tend to get you at least from one quartile to another quartile. But really, in the GFC, there were few places to hide. So to talk about GFC and consequences for strategic asset allocation. Credit and liquidity risk, I think that's a given. As an industry, we are very good at making sure that the last crisis doesn't happen again. So a lot of focus now on credit and liquidity risk. Cash will be cash. I think Sam said yesterday. The one thing that would be unforgivable is enhanced cash. And I think we had an experience where people have got investments in structures where the only thing that they want is a positive return, and all of a sudden they've got a negative one. So I kind of think enhanced cash is going the way of the dinosaur. Greater focus on objective setting. I think a lot of people will come back to grassroots and exactly what they are trying to achieve. I think they'll be looking at exactly what is the utility profile of funded members. More asset classes and pure plays. If we are going to model an asset class, well, let's model the asset class. Let's not model a bastardized hybrid. So let's have a look at something that is pure duration, or let's have a look at something that is pure small capitalisation. More passive. I think that's a given. I think the active returns and the way active returns correlated with beta was very scary, both in August 2007, when we had our first hiccup, and then through the GFC. So more passive. Where you are using active management, there will be more discretion given to active managers to de-risk. The idea that I think the terminology, long only absolute return. Managers given, say, an equity portfolio, but where they perceive valuations have become stretched and they can't deploy capital in investments where they think there's going to be an adequate return, then, okay, it's okay for those managers to hold cash. More explicit focus on inflation hedges. We saw, I think, Mercer in its multi-manager fund making more explicit allocations to inflation-linked bonds. Certainly many investors, Russell included, is talking about real assets. So things that hedge inflation risk. More thoughtful risk oversight. One of the things that will happen in governance, and I think there's a couple of governance presentations, is that risk oversight will become ingrained in processes. And a big part of that will be scenario testing. Everybody does some scenario testing. I think the extent to which that will be done, the number of scenarios will be run, and the range of scenarios run is going to increase enormously, and that'll become part of the governance process. Are equities an inflation hedge? I think this is from Ibbotson data. Looking at rolling 10-year returns, correlations between local market equity returns and local market inflation, data since 1900. No. Equities, somewhat surprisingly, are not a good inflation hedge. This chart, and I apologise that this data is a little bit out of date, it's from Gorton and Rowanhurst from 2005, but it's looking at the correlations between commodities and inflation, equity and bonds. And you can see there that the very positive, strong positive inflation, which is what you're actually looking for, in 5-year commodity returns with inflation. So it could be for diversification reasons that we see inclusion of more commodities in investment strategies. Just to wrap up, conclusions, long-term is hard. Long-term is really hard. And we shouldn't underestimate the challenge. It needs to be supported by good governance structures. The rules haven't changed. SAA is still an appropriate foundation for an investment strategy, and there is no need, as I said at the beginning, to throw the baby out with the bathwater. The final point there I'd like to make is that there is enormous value in good modelling, and a lot of organisations have thrown a lot of dollars at good modelling. But good modelling doesn't get you the whole way, and you need to take ownership of the objective function. You need to know that the objectives that you're actually trying to maximise the probability of achieving are appropriate, and the same can be said for the assumptions.